Last night we got caught in a torrential downpour and lightning, and we have our dog Rosie. It's fun. We're having fun. But anyway, I'm glad it worked. We had some tough times on the connectivity, but we have some very cool topics because last week we had our mastermind, the collective, and we had George Gammon there and Jason Hartman there and all our incredible members. And George and I and Danille are gonna talk about this ratings that the U.S. has got downgraded. But we're not gonna
do that yet.
Okay,
we're always jumping ahead.
We're gonna wait. Sorry.
First, let's dive into our van adventures. As Ken mentioned, we got caught in a torrential downpour last night. We went to dinner, and a storm came out of nowhere.
It was awesome.
It was, but we got very wet. And other than that, I booked some hotels because I'm not going to be staying in the van every night.
So, guys, listen, this is what happened. I crashed out like a light. I wake up. Danille's already booked hotels for the remaining part of the trip.
Not the whole thing. Just, I can only do so many nights in the van. For those out there that have a bad back like I do, you understand sleeping on a seat is not going to work for 4 more weeks. But I'm excited because all of the hotel sites are right next to the RV park, so I will be with you all day.
So I'll be driving the RV, dropping her off at the hotel, apparently. I just learned this.
I'll visit. I'll say hi.
Oh, she's going to visit.
Maybe if you want to come back to my place, you can if you want a hot shower.
Oh, my God.
Well, that was the other thing. So this morning I go to take a shower, and I had read a lot of reviews from this RV park, and they said there was no hot water. And I turn it on, and it's hot. And I'm like, oh, my God, I'm going to go get my clothes and everything. Well, then I get back to the shower, and the lady goes, oh, you better hurry. The hot water is almost gone. It was like 7 a.m. So I hop in. I had 2 minutes of scalding hot water, and then it went freezing cold. So that was nice, too.
Yeah.
So if anyone can relate, please comment. We're trying to make it through, or Ken's making it through. But then secondly is we had our collective event this weekend in Park City. The best part was we got a really nice hotel, but it also was a great event because we had George there and Ken and Jason Hartman and all the members.
Yep, said that.
So what was your favorite part?
Well, my favorite part was we went up on the Olympic Park with Olympic gold medalist that brought three skiers, one of which could win Olympic gold. And we got a private tour, and they jumped off from that Olympic tower. It was incredible. I couldn't believe how steep it was.
It was wild.
It was crazy.
We're going to post that on your Instagram story later today.
So that was fun.
Yeah, for those of you wondering, I keep going this way because I'm trying not to type on the computer because it bothered a lot of you, so I'm using my computer to type on over here.
Yep.
So let's jump into our Twitter question of the week while everyone gets in the room. Ken, you asked, what do you think are effective strategies for first-time home buyers? And I really like this question because we have a lot of first-time home buyers that listen. And Rhett says, think like an investor, not as a consumer. So kind of what my webinar was about a couple weeks ago was buy like it's going to be an investment because you don't know that it's not going to be an investment one day.
Well, and it might be. Like the whole idea, even Danille fell into this trap. When we first met, she was going to sell the one she was in and use the money for the next one. And I think that is a very common thing that people do. My parents did it, my sisters and brothers did it, so it's very, very common. But there are ways to do both. And so that's why that's a very good question. And if you can keep that one asset, now just think back to your first investment, your first house, even the house you grew up in, how much less it is than today's prices. And generally, the majority of that is due to inflation, which, of course, we're all seeing now. So that's a really, really great answer that Red had.
Yep. Let's go to response number 2. Jeff said, wait.
Yeah, that could be also a strategy. There's nothing wrong with waiting. I'm waiting on areas to go down. They haven't, but so there's 2 things that happened when I waited. We sold our house in Coeur d'Alene, and I thought that it was going to bust, after the pandemic. It has not. And what's happened is prices have stayed where they are, and now they've increased rates. So what I would have normally gotten is going to even cost me even more. So, that doesn't necessarily mean that was a bad strategy.
Right. We just don't know yet.
Yeah, we just don't know yet. So, we were bantering this morning over breakfast. We rode our bikes into Jackson Hole this morning, and we were saying, how crazy is this? We've had, 11, 12 rate increases from the Fed. It's been a crazy 2 years, yet prices are still going up, and in many areas, rents are still going up, and it's the Achilles heel for the Fed, because housing, as we all know, is the biggest expense for most people.
Yep.
The mortgage payment, the rent payment, and everything associated with that. So it's a big problem still, because typically higher rates do pop prices and do adjust rents negatively, but it hasn't happened this time around.
Right. And a lot of people always want to know if we see a correction in the housing markets, and there's just not a lot of supply. So it's just really hard to know. If you talk to Jason Hartman or Kathy Fetke, they'll tell you that there's not going to be, they don't see a big correction coming. We go back and forth on the residential market, but I just bought in Scottsdale because I found something that barely cash flows, but it does, and so it seemed worth it. But yeah, it's up in the air right now whether or not there'll be kind of decline.
I do think that you got to pay attention, like you should have before, is that there are markets that are not doing well. So, I would let those continue to slide. Primarily, we're seeing those in areas that have political governments. The ones that people are afraid of their safety. Where they defunded the police, let's say, or some of the riots were, or those kinds of things. So we are seeing that. And people are moving away. They're voting with their pocketbook. They're moving where they want to move. And so I think, one of the things we might want to do next week is that there's like a California effect going on everywhere, at least in the West Coast. We were just in Boise. We were just in Park City yesterday, and McCall, Idaho, and of course up in Coeur d'Alene. And it seems like a lot of people from California are moving throughout. They're probably moving to the East Coast too. So I'm just
Well, on the East Coast, it's more like a New York effect, right?
Yeah. So it's interesting to see, because what was $1 million for them, is a typical home, and or more in many areas of California. So we are seeing that kind of. They're moving to some of these markets, and that's what happened with my house. The couple was from San Francisco. They bought it all cash, 21-day closed, no inspection, and it was a lot. And I looked online, and their house, I think they sold, was like $17 or $18 million to get out of San Francisco. So I think you are seeing a little bit of that. It's kind of propping prices up. But when we were in Boise the other day, it was not popping. Even though Boise was one of the fastest, largest economies. Now, it might be in some markets, sub-markets, and those kinds of things. But you just got to pay attention to that. But overall, we have an inventory problem.
Yep, absolutely. And let's get to our third Twitter comment. Antonio says, house hacking, but instead of expecting to live for free, live for cheap.
Yeah, that's good.
Good idea. Make it work for you. You can get a house in this market, to his point, if you can house hack some rooms and you can just have a cheap mortgage yourself, cheaper than your rent, then it will make sense.
One of the things that really makes sense, guys, is like what Danille just did. For whatever reason, there's a tremendous amount of people moving to Scottsdale, Arizona. And whether it's weather or job availability or whatever it might be, it's just a fact. So, however, Phoenix is actually experiencing some softness, but that's different. So these little submarkets, and Scottsdale's not a small town, but she's been buying these $500,000 homes, or $500,000 to $600,000 homes, not condos, homes. And because of the amount of people moving there, they're willing to pay $3,000 or $4,000 a month in rent, and it's been more than enough to cover her expenses. So that's something to think about as you start to see these migration patterns, whether it's Florida or areas of Texas or just even pockets in Austin. We've seen Dallas. People are moving, and they're creating little price hikes in certain markets, and there's a lag on the single family side, so that's certainly something to look at.
Yeah, absolutely. And you're always going to have inflation, as we're going to talk about today, working for you when you own real estate, so you always have to consider that as well. So let's before we dive in, hit the like button, because that really helps us out and we appreciate it. And now let's dive into the topic. So I'm going to move my computer over here.
It's fun. We got hundreds of people watching right now.
I know.
Thanks, guys.
So how the Fitch rating will affect rates moving forward, and what it means for inflation and real estate. So this is a very complicated subject. It is not straightforward. I was happy to have been able to chat with George about it. We both were this weekend. So if you're looking for a straightforward answer, it's not straightforward.
That's okay.
Yep.
But obviously the word downgraded should have you concerned.
But all the news stations says it's no big deal.
I know, but how could you possibly think that the word downgraded is positive? How do you put a positive spin on downgraded? But downgraded is downgraded, and the economics and the issues behind that downgrading is not necessarily good. So even though I just don't think that most of the media really understands.
Well, they don't, because it is complicated. So the Fed looks at something called the Phillips curve. And the Phillips curve is what they base every decision on. And you guys have to really understand that. So it basically measures unemployment versus inflation. When one goes down, the other one should go up.
But that's not happening.
Correct. So it's not happening right now. So right now inflation is up and unemployment is
right. So
down.
Let's take a look at it. Yeah. So right now, as you guys know, we had high inflation at, say, 9% last June. And at that time, one of the issues the Fed had was low unemployment.
Right.
So now we've gotten it all the way down to 3%, and we still have low unemployment. So that's the issue. So low unemployment, although this is a little counterintuitive, is as wage growth is inflationary. So the Fed's number, if you look on the internet, you'll see that they believe that stable unemployment sits at about 4.1%. And so right now we're at like 3.5 or 3.6%. And so with inflation coming down, they were hoping that unemployment would go up, and that hasn't happened. Can you put that curve back up?
Right. They need unemployment to go up per them based on their chart. They need unemployment to go up for inflation to go down. So everything that Jerome Powell is doing is to get unemployment up, because in his mind, based on this chart, that's what happens to happen for the inflation to go down. So that's why they keep upping rates, because there's really not a downside to him, because he needs unemployment up. That is what he wants. Now, when Jerome Powell was actually probably pretty happy that Fitch downgraded our rating.
Yeah, that's what George said, yeah. George Gavin. So why don't you walk people through that? Because George thinks that this was that somebody at the Fed called the DOJ. But I don't know let's talk about what George said.
Well, he just said that he thought that they were happy because Fitch. He said, of course, Fitch downgraded, our ratings. We have all this debt and everything else. But that does slow down the economy. Business owners look at that. The government looks at that. Everybody looks at it. They can say it's no big deal, but they do look at it. And, people investing in the U.S. look at that. I was reading a medium from Japan, and they were saying how this was a big deal. So other countries are looking at this. So that in and of itself could slow down the economy, which is what Powell wants. So his only tool to do it is hiking rates. Like, he doesn't have another tool in his tool belt to get unemployment up. But Fitch, by downgrading us, kind of maybe helped it along a little bit, and without him having to hike rates, may start to slow down the economy, slow down investments in the U.S., and raise unemployment, which is what he wants. So realistically, even though the administration and Biden and all those people don't want that because it doesn't really look good for them, especially going into an election, the Fed is not necessarily Biden, right? So for the Fed, this was actually kind of a good thing.
Right. So he needs, obviously, guys, inflation needs to slow down more in order for things to stabilize. And in fact, they've even said at the next Fed meeting they're going to continue to raise another quarter point. I read there was something that came out this morning by one of the Fed members that said that they still believe that they need to increase rates. So even after all of these rate increases, the Fed still believes. If you look at, there's something called the dot plot, P-L-O-T, dot plot. And the dot plot has each individual committee member has a dot. And there's 18 of them, I believe. And they actually, obviously not all the committee agrees on a rate increase or a pause or a reduction. So there's a dot plot, and the dot plot actually measures what each committee member is planning or thinking about or voted toward for the next meeting. So take a look at dot plot, and dot plot will show you that the majority of the committee is committed to raising rates again. And I think that's a really good leading indicator for the next meeting.
But also, as George said and Joseph Wang said, Jerome Powell really has CEO authority on what he does. So it doesn't really matter necessarily. I mean, what the committee members vote on, I'm sure, is taken into consideration. But it's all it is consideration, because he has the power to decide what he wants to do.
Yeah, but what's interesting, if you really dig into the Fed's minutes, which I've read, you can see that the media is not paying attention to what's in the minutes. So that's what I found by first starting to read the minutes in May. So oddly enough, I didn't go back and read the minutes prior to May, but I first read the May minutes, and what I was seeing in the media was far different, which was reflected in the actual minutes. And I think you'll see that they get into the granular, they get into more of the details of all the things like food and obviously gas and housing and energy and all of those things are actually reflected in the Fed's minutes. Now, for those of you who don't want to read it, just go to the dot plot and just type in Fed dot plot, and you'll see that there are definitely some Fed chair people that believe that rates should be cut. And there are definitely some that believe that they should be paused, but the overwhelming majority believes that they should go up.
Yeah, and it is interesting. It could potentially slow down rate hikes. George was also saying, just because now there is some additional pressure now that we were lowered on one rating system, right? And it's kind of exposing to the world, which was already known, but it's just exposing it in a different way. Our banks are unstable, our debt's unsustainable. When we hike rates, we have to pay additional debt on all of our, or additional interest on all of our debt. So there is a chance, though, that this grading system could slow down Powell a little bit, potentially.
Yeah, there's two big issues, actually. One, if you think about the combined, and I talked a lot about this on my Friday videos, but there's $1.5 trillion in commercial debt that is actually going to be maturing by the end of next year. And so while many of you might not think that that's a big deal, it's a big deal. So office buildings are toast, and multifamily right now, there's an article in today's New York Times, or it could have been Wall Street Journal, I can't remember which one, that basically said that multifamily is in big trouble as well. So that multifamily has been repriced 15 to 25% less from 1 year ago just because of the interest rate hikes. And so the capitalization rates have gone up, and so it's lowered their values. And so many of the properties, office and multifamily, are actually not worth the actual debt. So what happens? Certainly all the investors are wiped out. But also, if it's below that, like which is certainly going to happen, then the people that own that debt are also going to take a big hit. And so that's going to be the small and regional banks, and that's also going to be pension funds, life insurance, 401ks, those kinds of things. So that's all managed money. And not all, of course, of that goes into commercial real estate, but pieces of it do. That's why it's important that you guys understand this. If there's a correction, and if there's a maturity, like one of the greatest examples is the Wells Fargo building, which is an iconic building in San Francisco. 2 years ago, it was valued at about $250 million, and it just sold for $70. Okay, I can assure you that the loan on that property was probably $150 or more. So whoever held that loan took an $80 million hit, and that made its way through, those quarterly statements that a lot of people go get. So that could be a life company, it could be a pension company. So you got to actually take a look at who held that debt. Same thing with multifamily, and most of this debt, which is the biggest issue, is held in small and regional banks. So I did a couple of videos on this if you guys want to take a look and dig a little bit deeper, because I went into very specific detail about what percentage is held in the small regional and local banks and how much are held in the big banks. This is all part of that Fitch ratings. So and this is yet to come. And the video I did 2 weeks ago called Red October, which means that $8 billion of multifamily comes due in October. And guys, that's not even 2 months away. So, these are going to happen. These are going to get repriced. And you're going to start to see potential banking issues as a result of whoever holds that paper. Forget about the investors at this point. We're talking about debt now. We're talking about, because the banks, if they can get their debt back, they're fine. The investors are wiped out. This is actually cutting into the debt itself, which gets into more of some of the potential banking issues. And that is what you're going to see. So you're going to see tighter underwriting. You're going to see lower loan to values. You're going to see more collateral needed. You're going to see personal guarantees. You're going to see all of this stuff in the next 4 or 5 months. And I'm telling you guys, it's coming. So that's why I think if I were in your shoes, I would put things on pause, get heavy in cash, and then just let this kind of play out and let the dust settle through the holidays, and then take a look at where you're sitting in the first quarter. That's exactly what we're doing.
And you're talking about for multifamily, correct?
I'm talking about if you're a commercial bank and you have office, you have retail, and you have multifamily, you have single family, you're probably going to be facing some loan defaults. Remember, a bank is in business to do business with everyone. So they have business loans, they have HELOCs, they have single family, they have office, they have multifamily, they have retail. They're in the business to lend. So, a lot of people, when you start to just talk about single family, it's safe and it's fine. You're probably correct. But that could be a very small piece of the debt that the actual bank has. So, banks are in business to do loans, not just on single family. In fact, no bank would just do single family, because why would you want all your eggs in one basket? Just like you wouldn't want them all in the office building basket. So they're also diversifying. So that's what I mean.
Yep, exactly. And John was asking, do you think that Red October is going to cause the stock market to fall as well, or are you informed on that?
Yeah, that's a great question. I don't know. It scares the heck out of me. So the office market is a little more institutional than the multifamily market as far as debt and equity. So when you drive into some of these big downtowns and you see the life companies up top, New York Life or Mutual or whatever, those are typically funded by, I would call it the American worker. You think about it, like if my dad worked in the sheet metal union. His union money was invested through his pension, and those pensions are invested, whether it's or if I put money into a life insurance company or whatever, that money, you oftentimes don't even know that it could be sitting in those assets. So I think that, that is more of a Wall Street. Right. That's more Wall Street money. Multifamily is a little bit different, where you can go out and get if it's Fannie or Freddie Mac, maybe not on the debt side, but a lot of those are put together by high net worth accredited folks, and just hardworking people that are trying to invest with the right syndicator. And we've already seen some of that bubble up. We saw, I think it was Arbor Trust out of Houston, already defaulted. He was on the cover of the Wall Street Journal, the New York Times, and we're starting to see more and more, kind of cracks. So it's going to be very different, but it obviously will affect whenever there's defaults. I believe that people, because you got REITs, which are REITs for malls and office buildings, and REITs, which are real estate investment trusts. Those are that's Wall Street. So this will all make its way through the system. And so it's very possible.
Absolutely. So it's something to keep watching for sure. This is obviously all very complicated stuff, but no matter what you think, they want the unemployment up. Fitch helped do that. So hopefully
that's
rates
surprising
can lower,
actually,
can stop going up so much.
That's what George said. So I remember Jason Hartman was on stage this weekend. And Jason really understands single family. In fact, we're going to have him on our next happy hour. He's got some incredible stats around the single family, and so we asked him to be our guest for the next happy hour. But what George said to Jason, which was great during the middle of his presentation, was, what happens if unemployment goes up? So George's thought was, what happens if some of these people lose their jobs? And then they can't afford to pay their mortgages as a result of losing their jobs. So that's what rising unemployment means. And I think roughly we could be talking about 1 million people. That's 1 million people. So if 1 million people lose their jobs, it's probable that a lot of them are going to be in single family housing. And many of those could, not necessarily will, could have a problem paying their mortgages. Obviously, it depends on their own individual circumstance. But, and so that was a very good question that George asked, is what does happen and will happen if unemployment goes up? Because the Fed has said that it needs to go up. All right?
Yeah. And if you're enjoying this, please hit the like button. Really helps us out. Would love to get to 100 likes. We're only 47 away. But we are going to jump into some of these questions from our Inner Circle members. So if you guys want to join Ken's Inner Circle, just go to KenMcElroy.com/join-now. And then, or you can just scan the QR code. Also, if you're watching on YouTube, make sure to ask questions. I'll try to get to some of them. So Francisco wants to know, what is the legal vehicle that suits a person who is starting to buy and manage properties?
So, great question. So, Francisco, a lot of this is going to depend on your own individual tax advice. But for me, I've been using LLCs. So, an LLC is a limited liability company. And what happens is the property sits, or the asset or the business sits inside of there. You have a bank account with that name on it. You have an EEIN number, which is an employee identification number, everything, and there's a tax return for it. The cool part is it flows through the LLC straight to you. So in the form of a distribution or whatever else. With a corporation, there's a couple different kinds. There's an S Corp, which is what we used to use a long time ago, or a C Corp. Here's the problem with the C Corp. If the business sits in the C Corp, then that business is taxed at the C Corp level. Then the money that comes out and is given to you, you are also taxed as well. So the thing about a C Corp is you're actually doubly taxed. So you have to take a look and with your CPA to find out the exact strategy, because we have C Corps in some assets, like our construction companies are sitting in C Corps. Our property management company are in LLCs. We have a couple of those. And then also all my individual assets, my properties that I own, they're all in LLCs. And let's don't forget about the purpose of those. The purpose of that is for asset protection. But secondarily, you want to make sure that you're not getting doubly taxed. So with an S Corp, it flows through. With an LLC, it flows through. But with a C Corp, you're taxed 2 times.
Yep, absolutely. So our next question is from Soleil. I hope I'm pronouncing that right. It says, I live in Dearborn, Michigan. Is it time to buy a home to invest or wait, as I don't have much of a down payment? I would have to do FHA.
Oh my gosh. Soleil, I'm sorry. I have not been to Dearborn, so I would hate to give you advice on a market that I've never personally experienced. Maybe in the chat here, some of the other folks that are joining us can help with that. But generally, Danille, why don't you talk about when you decide to buy something, what makes you decide on one city versus another?
I want a city that people are moving to, that has a lot of industry in it. Even though I'm from Ohio, I don't invest there, even though there are good parts of Ohio. But the area I'm from, it's not really growing, I wouldn't say. So I would definitely look for that. And you definitely want to look for, good insurance prices, good property prices. The one good thing about Michigan is you probably get a less expensive home for an investment. But you have to really see if it cash flows and see what you're going to be able to rent it out for. Because while it, is cheaper, it also has cheaper rent. So you really need to know. We've done a lot of videos on cash flow. And if you can buy something that cash flows, I would do it. And if it doesn't cash flow, I wouldn't do it. And if it's a first-time home for you, I would really look at what your payment's going to be. Is it going to be cheaper than your current rent, or is it going to be more expensive than your current rent? If it's going to be more expensive, you might want to think about not buying yet. If it's going to be cheaper, then it might be a good idea to buy your first home.
Yep, great. And don't forget, if you decide you're going to buy something and you decide, let's say, put it in escrow next week or the week after, don't forget that the interest rate that you get is going to be part of that factor, obviously, on the cost of debt. And we are looking at more potential increases. So just be careful of that you might think it's one thing today. It might be another thing tomorrow. That's certainly happened to me, where we were in escrow and interest rates went up. And so we had to drop the deal as a result of rising debt costs.
And Amy said Dearborn has a lot of industry with auto and tech, because we're not familiar with the area. And Lookup says, buy wherever Texas Roadhouse is being built. That is a true thing, though. I know that I like to look at the areas that Whole Foods are being built, because I know they do their due diligence on areas that are growing that can support that kind of store. And so a lot of my properties are actually around different Whole Foods markets. So if you find something like that, they're a big company and they do their homework, and so you can kind of leverage off them too.
This is a great thing that's not talked about enough. Back in my day, they used to call it the McDonald effect. So wherever there was a McDonald's, that was always an area that you would want to grow to, because you can imagine when McDonald's was in its heyday, they had a whole real estate department. In fact, I met the guy that was all over the country, and his job, obviously, he's not going to award a franchise to somebody and have it fail as a result of being in the wrong location. So part of their job is to go where people are, or they're going, or where there's a need. And so it's a fascinating idea to be able to follow some of these big businesses that have these huge departments, for real estate research, because all of us are doing our own research, and so is big business, big corporations. So it's a really astute comment that was made.
Running with Altitude said he looks for Costco's.
Yeah,
so.
Costco's it would be another great one.
Yep.
Yeah, actually, if you guys think about it, why don't you what's happening in your town? Like what franchises, what new places are entering, and why? Because as you can see, Amazon warehouses is another one. Although I had one in Tucson that I built next to, and they decided not to staff it. Walmart's within a mile. So those are really, really good ideas, because there's a tremendous amount of employees that work at these places.
Yeah.
Also, one of the things we're starting to see are Trader Joe's and Starbucks. Yep, are mall redevelopments. So we were just in Idaho. There's one big one going on in Phoenix. It used to be called Park Place Mall, I think it was, and it's completely being redone. And there's obviously big lenders are not going to finance that kind of stuff, and we're talking about movie theaters and hotels and multifamily and retail and restaurants. So all of that stuff is really, really, really important. It's all real estate, obviously, and all kind of drives toward investing in that particular submarket, because people want to stay near where they work.
Yeah, they definitely do.
It can work the opposite too, by the way. So pay attention to companies that are downsizing, because that's happening as well.
So I'm going to jump over to YouTube. AK asked a question. They asked, I'm considering buying my second home, and I'm considering renting the home I live in now. Can you give me any tips?
Well, you've done this a lot, so why don't you take this one?
The biggest thing is you need to be picky on your tenant. Make sure you do a credit background check. Second thing, and this, I had to really wrap my head around this, it was hard for me initially, is that home is now a rental. So you can't get emotional around it. Oh no, what if they ruin my perfect countertops? Or oh no, I put this amazing flooring in, what if they scratch it? So all of that is going to be, a bigger issue.
Yep, and
have an airtight lease. And
don't spend a lot of money on getting it ready for the next person. In other words, I see this mistake a lot too. It's a rental, so you're going to want to expect carpet, floor replacement, appliances. We just replaced a refrigerator, and we own one rental together, just went out, and so you just got to know that this is stuff that just continues to turn, whether the water heaters, etc. Now, I've been, one time I was building a home, and it didn't quite get done, so I had to buy another brand new home in a great area that was going to be a great rental, and I kept it as a rental for 9 years, and my next door neighbor rented it for 8 years. So I stayed in it 1 year, and then him and his wife rented it for 8 more years. And so these can be really good positive experiences as well. So you don't necessarily have to have a lot of turnover if the home is in a great location and it's in need as well. You can really cash flow it, especially if you have a great mortgage on it. So that's probably the big thing is right now a low cost mortgage, which is call it a low interest rate, is actually an asset. So if you're sitting on a 3% loan, the worst thing you could do is give that up, because you're basically beating inflation right now.
Yep. So our next question comes from Moretta, and I think this is a question a lot of you should pay attention to. She said, if someone has a small 401k and is not of retirement age but would like to cash out and put it towards investing into a hard asset like real estate, do you think this could be advantageous? With the instability of the banking system and fiat currency, it seems like early withdrawal could possibly make sense. So the reason I like this question is because there are ways to not have to cash out your 401k and then still invest in hard assets, and a lot of people don't know that.
There are a fair amount, guys. You can move them into individual retirement accounts, self-directed retirement accounts. So you can actually move it to, again, literally, it's so once somebody else is directing it, and this is just moving it to self-directed. You still have some restrictions around it, so you got to make sure you understand those. But that's one. And then I know that there's also, isn't there a way to move this into Roth IRAs?
I don't know. I do know there's ways to invest it without taking it out.
Yeah, so paying the 10% right now with today's environment, probably not a good idea, depending on what is actually invested in. And so that's the first thing I would look at, is what is it invested in? And you can actually move that money to a self-directed, and then from there you can actually use it for whatever you want. That's what self-directed means. So just Google self-directed retirement accounts. There's for sure somebody near you. You want to find a reputable company, but they're essentially just like a bank. And you can just move your money over there, and then you can start to make some of these decisions. And you can actually pair this up with debt. There's all kinds of things you can do. But it's basically managing your own money that's sitting in that account without having to take that hit.
Absolutely. And we're 3 likes away from 100, so hit the like button. All right. So the next question from Inner Circle comes from Joe. I'm thinking about buying a home in a better neighborhood with better schools. Do you think single-family residential will drop after October, or the price won't really change very much? He doesn't say where he's at.
It's a good question. I just don't see a huge drop in single family right away, if it even happens. And so we're now getting into some serious affordability problems. If the Fed does its thing, which is essentially really make housing more affordable, because if houses are still going up, that's a problem for the Fed, because that, in theory, is inflationary. If rents are still going up, that's a problem for the Fed, because rents are inflationary. So I don't think the interest rate increases have done anything yet, and I don't think that just what's going to happen in October will happen immediately. Just like everything, there's a lag. And that's why I was saying, just let everything kind of play out this year, and then really take a hard look at, first quarter of next year, and maybe you can start to see some of these, neighborhoods going down. But if you're, if it cash flows, then, I think you're good. Like I'm always looking at real estate. This morning I was talking to Danille about Jackson Hole, because it's super expensive here. There's not very many homes under, $2.5 million in this whole city. And some, I looked at one last night online that was 40. So, so what does that mean? That means that nobody here that's working $25 an hour jobs can afford to own anything. And so all of a sudden that becomes a huge opportunity. Not a bad place to park cash, because you're always going to have, a scarcity issue, and you're always going to have, this is kind of a tourist town, it seems right now at least, and certainly there's a ski hill here. So you're always going to have that renter base that's going to need some place. And so not a bad place if you want high occupancy over a period of time. So that's how I look at, I'm not suggesting you invest in Jackson Hole. I certainly haven't. But the point is, the fundamentals lend itself to be able to park some money here, and know that you're probably going to have, unless you have something like the pandemic where everything shuts it down again and you don't have any occupancy, movement, I should say, and businesses are closed. So that's the way you have to look at it, is that way, and just make sure it cash flows.
Yep. And I want to address Henry. So basically what's going on with Henry on YouTube is he had a tenant who's breaking the lease by having additional people, a lot of people, stay in his apartment. So there's people sleeping in the garage and all this stuff, right?
Yeah.
And he doesn't know what he can do. And I had asked him what state he's in, because that will make a difference. But what I would recommend doing, Henry, is first talk to your tenant about it and try to reason with them and let them know that this is against the lease terms and you're going to proceed with an eviction, however that goes, because you're breaking the lease. However, it depends on your state, because some states, Washington, California, New York, all that's going to take such a long time that you're almost just better off riding the lease out and waiting till it ends. If you're in more pro landlord states, you may be able to get an eviction. But I don't really ever want to evict a tenant, so I'm always super open with my communication. I've had tenants that continually violate HOA laws and different things, and my plan is always just to talk to them and start fining them, the HOA fines that they're getting. And because I don't really ever want to have to try to evict someone unless they're really not paying rent.
But on the other side of that,
mm-hmm.
there's a fair amount of tenants that will abuse the landlord.
Mm-hmm.
I don't know if this is that situation, but on that particular case, you got to get assertive, and you have to really take a very proactive step toward challenging them based on the terms of the lease. So the way I like to handle this is, I just start with the lease. I don't ever worry about the consequences of them hiring an attorney or anything like that, as long as it's legal. And if they're breaking the lease, which it sounds like they might be, or if they're in default of terms in the lease, then I think that warrants itself some very serious letter writing, maybe hire an attorney to do a letter for compliance and all that kind of stuff, and you've got to start down that road anyway. Another thing that you could do is, which I've done. One time we had somebody slip through, and they moved in, and they were a sex offender, and they were supposed to register in the state of Arizona, but they did not. So they moved to, I believe it was an Indian reservation first, and then they moved into one of our properties, and our service at the time did not catch that they had that issue in a different state. So when they registered in, the law is that they flyered the whole neighborhood. So now we had a sex offender living in our unit with very unhappy people around. So what we did was we went to them and said, listen, you were supposed to register. Let's forget about that. But we need you out, and we'll pay for you to leave. So we actually cut a deal with the tenant right then, and we actually gave them money to move out. And they were fine with it. We let them break their lease. It was a win-win. I was able to take care of the neighbors and say, hey, they moved. Didn't have to tell them what happened, but the tenant and the landlord made a deal, and that was fine. So there are situations where you can actually go take care of these things, and especially if it's being disruptive. I mean, if people are sleeping in the garage, he's probably cash flowing all over the place.
Yeah, he's renting all that out.
He's doing a nightlies. But that, there's a number of ways, but it all starts with communication. If you can avoid legal, do. I find that most of the time these things can be handled pretty directly. The other thing is, the people that are all staying in his place for sure do not know, I'm guessing, that he can or can't do that. So you can actually be super proactive and just show up and start asking questions and disrupt, whatever he's got going on over there too, just by asking questions like, who are you? Are you on the lease? And those kinds of things. So that's another way to handle some of that.
Yeah, absolutely. Jody from the Inner Circle is asking, would you take a German Shepherd in one of your units?
So this is one of those questions that, I probably would not if it was, like a second floor unit. You can do breed restrictions and you can do weight restrictions inside of a pet policy. Pets are not a protected class. We do pets because we believe that the we'll actually get more renters. So if it's a house like we have a fenced yard, we were fine with pets. They have to pay a pet fee, pet rent, all that kind of stuff, pet deposits. So we'd probably be okay there. So a lot of it just depends on where. Obviously I'm a huge dog lover. We got a huge national award by the, I think it was the Humane Society, by allowing pets. So,
but you have breed restrictions,
right? We do have some breed restrictions. I think I don't know if German Shepherds are on the list, but pit bulls are definitely on the list. So there are certain things that other people are afraid of. Other people, so we do have that in our pet restrictions. But on a house with a yard, I think it's fine. My experience has been that most people are pretty good pet owners, we have friends that love German Shepherds, and I think their dogs are better treated than most humans. So
I try to stay away from the bigger dogs in my units just because they're smaller. And, well, I shouldn't say that. Certain bigger dogs, like a golden retriever, not really. But I don't like the more aggressive breeds. I don't know if German Shepherds are on the not insurable list, but you need to look at that because most insurance companies will not insure certain breeds of dogs. So then it would be a for sure no-go for me. But even, I also look at just the breed and the activity level and how big the place is and if there is a yard or isn't a yard. Because you don't want a big dog trapped in your unit with no yard because they're going to damage things. So it's kind of case-by-case basis. Noah is asking, my HOA doesn't allow rentals, but do you think I can get away with putting someone in there anyways?
I'd be careful with that. Also, this is a property right issue. Does the HOA have the authority to direct whether somebody can rent something or not? You might want to dig deeper into that because most HOAs don't necessarily restrict rentals. What they're trying to restrict are short-term rentals. So you might want to look at that because my experience has been that I don't know if HOA actually can say if you want to rent something for 6 months or a year. But I could be wrong.
They can, because the first property I almost bought before I knew you was a no rental HOA, except the people that were grandfathered in. Yeah. And AK says on here, don't mess with the HOA. So I almost made this mistake, Noah. My first property that I wanted to buy, I loved it before the one I ended up buying, and I was not allowed to rent it, but in my head I'm like, well, I could rent it. I mean, they're not going to know because I didn't know anything about HOAs. HOAs are very, very, very nosy, and they will know. They will know within 2 or 3 months, guaranteed. Like, if I don't put my trash can away within a day, the HOA knows. If I, like, for example, I always tell the story. I had my first tenants move into one of my places. The HOA literally knocked on the door and asked to see their lease because they thought that they were renting less than 30 days. So they're going to know, and I just wouldn't even mess with it. I wouldn't even buy it. If you have that kind of property, you could always sell it and roll it into a different property that you're allowed to rent, or just stay living in it, but they're going to know.
Yep. Check on that 30-day piece, though, because in Danille's case, they could do over 30 days. They just said that they didn't want Airbnbs in there, basically, or vacation by owners for, less than a month.
Yeah, on the one property, but not.
Yeah.
But the one that I didn't buy, they wouldn't allow it. M. Deering said defund the HOA. Awesome. Well, we're going to wrap up the show. Thank you guys for joining. We will see you next week. Next week we'll be coming live from Denver, and we'll be in an actual Airbnb, I think. So that'll be nice. And we'll see you then. I'll give you some more details.
Thanks for joining us on the road. We appreciate you all, and we love doing this. We'll talk to you soon.